I always try to live up to Kim's introductions. It's tough for me. Thank you all for coming. This is awesome. I'm used to, usually they have me speaking after everybody has some drinks and walks around the exhibit hall, and then I'm the nighttime show to see who's going to hang around before they go gambling. I am excited to be here, as I always am. Kim was right. I will go to the ends of the earth or to Bally's Casino to find customers, because it's so damn hard to do what we do and to talk to people about, markets and trading and just to find kind of people that are passionate about, finance. I love it. So anyway, I'll tell you, oops, kind of loud. Let me move over here. Beautiful. So I do a daily show for about 3 hours a day. Well, three and a half, 4 hours. We do it 8 hours a day at tastytrade.com. It's a live show. We talk about finance and everything else, dogs, kids, life, and the whole deal. But I love my show, so I do the show in the morning when I have an event in the afternoon, and then I fly out to Chicago. So did the show for 2 hours this morning, and in order to make this event, I tried to catch an early flight out to Vegas from O'Hare. As is usual the case, I get to my gate, and United has technical issues. So I'm kind of like, so I had to make kind of one of the things I love about trading, and one of the things I love about investing, and for those of you, for some of you, this is your first time hearing me, and for others, you've heard me, maybe dozens of times over the years. And my big pitch is, the reason we're all here is that we learn to not just assess risk, but to make decisions really quickly. Like the art of success is really based on your ability to make decisions. And so I had this decision to make. Wait for United to come up with an actual departure time or a second plane, or book a flight on American, which was 2 terminals over. If you've ever been to O'Hare, United flies out of Terminal 1, American flies out of Terminal 3, which is about for a normal person walking about 20 minutes, for me, about 2 hours. So I decided I had to make the instant call to jump on an American flight that was leaving 2 hours after my original flight, figuring the United flight was never going to take off. So made it over to the American flight, hopped on the plane, got here, it all worked out fine. But the funny thing was, markets were busy today, and real busy. Dow was, I think, down 600. S&Ps were down, at the end of the day, maybe 52 or 53, and the NASDAQ was down. When I logged off, when they made me log off, when the flight attendant actually closes your laptop? That's usually like the message, like, okay, all your additional time is up. They were down, NASDAQ futures were down 199. So it was a pretty nasty day on Wall Street. And I've got a lot of positions on it. It's kind of in the option world, it's expiration week. And so I'm sitting next to this woman who was kind of trying to sleep, but listening to, we have on our platform, we say we love the ding, which is basically the sound that an order makes when it gets filled. And I don't like turning my sound off, so I try to turn it really low, but it doesn't really go super low because it's an old laptop. So every time I make a trade, the ding goes off. So I'm sitting next to this woman, and I made 90 trades on the flight out. So the ding went off 90 times. But you see, when you fill an order, like let's just say it's a single order, and it's a 1 lot, the ding goes off 1 time. But if you fill like a 20 lot, and it fills in partial, like it goes to lots of different places, the ding goes off like 20 times. So it's busy today. I filled a lot of orders with a lot of partial, fills coming back from multiple exchanges. The ding went off about 300 times. And all this woman heard me say the entire flight was, I stink. Because as you get older, do you talk to yourself? Like, I never used to talk to myself. I went through my whole life, I was like pretty quiet, I don't really like talk out loud when I'm walking down the sidewalk. I'm not a crazy person, or I didn't think I was. As I got older, I started talking to myself. And I heard myself out loud just saying things. So on the flight, I was saying to myself, the market was down big. I was chasing some of the down move. I'm kind of like chasing my deltas, trying to stay short. And I kept saying to myself, you stink. You stink. I stink. I couldn't believe how bad I was on this flight. It's bumpy, and I'm chasing stuff on a wireless, go-go connection. And I kept saying I'm stinking, and then finally the woman looks at me, and the ding's going off about 200 times, and I keep saying stinking. She's like, "Is there something wrong with me?" And I'm like, Seriously, I promise. It's me. I'm just talking to myself. I stink. She goes, I don't even know what you're doing, but you're talking to yourself. I go, I know, sorry. I didn't mean that it's obvious from my performance today, I didn't know what I was doing either. So just take it, trust me that I think I know what I'm doing most of the time. So anyway, I'm excited to be here because Bally's is not only the venue for this, but it's also a place that I've actually been coming to Bally's, believe it or not that often, but it's the scene of my largest and only win ever in Vegas. 1995, we were at a bachelor party. We played Baccarat for 2 hours when they used to have a Baccarat table down there. We didn't lose a hand for 2 hours. My single greatest weekend in Vegas ever. I have not won since 1995. So they're way ahead, but I'm still up on Bally's. Anyway, but I do love coming here, and just like Kim says, I don't think I've missed a show in many decades, well, in the last 2 decades, and I love these events because, and I don't understand why, I always say kind of the same thing, but you got to hear it one more time. I don't understand why there's not 5,000 people here, or 10,000 people, or 20,000 people, because it's so important. And I also don't understand why all the firms in the world of finance don't understand how important these events are to go out and to meet everybody. There is a huge value in just being able to see somebody's name, to be able to network, to be able to talk to other people that think the same way you think, that act the same way you do, that make the same kind of decisions, and also just to talk to them and just get different opinions. It's tough, this investing stuff, this finance stuff. The markets are incredibly efficient. And the edge today is in understanding how to apply the content. The technology has commoditized everything. The analysis is virtually the same, everywhere on everything. The difference between success and failure, or even success and marginal success, or marginal failure and a little bit of success, whatever it is your ability to understand how to apply strategies and concept. So what I've done today is I've been using the same for the last month or so. I've been giving kind of the same speech a couple of places around the country. I haven't done it here yet in Vegas, so I'm excited to do it today. It's pretty fast paced. I know the exhibit hall opens at 5, and so we'll be done at 5, I promise you. I'm really good with time. It's one of the few things I'm really good with. And so I hope you enjoy it. It is a piece today focused on some of the things that are just some of the things that strike me as interesting about the world of finance and about things that you can take away. One of the really important reasons I'm here is not just to have an opportunity to say hi to everybody over the next couple of days, to take a picture, to shake hands, to answer questions, which I think is incredibly important, because every time I've had an opportunity to do that with people that I'm interested in whatever they do, it's changed the way I think. When I've had an opportunity to meet incredible entrepreneurs, there's always a lasting impact, and I pick up something from it. So what we do is we focus on takeaways. Every 10, 15 minutes, every 7 minutes, whatever it is, there needs to be a takeaway. In order for something to be valuable, in order for people to really get something out of an interesting discussion, there needs to be takeaways. So what I've done is I put together a series of takeaways so that whether or not you trade stocks, options, futures, we are completely product indifferent, which means we're strategically indifferent, we're product indifferent, and our focus is on risk assessment, it's on decision making, it's on entrepreneurship in general, which just means taking control of your own finances. It's about making all the decisions yourself. There's no reason that every financial decision you can't make yourself, and there's no reason that anybody else out there should have any advantage, edge, or know-how edge over anybody in this room. I believe that the group that we talk to almost on a daily basis, which is 100 or 125,000 people strong, has as strong a foundation, as strong a knowledge base as anybody that's managing any amount of money anywhere. And you'll see me talk about that today, which is kind of so important. So without further ado, I'll take you through this presentation, which is, like I said, it's pretty fast paced, it's fun, and afterwards I'll be in the booth, which is right inside. That's our Tastyworks and Tasty Trade booth. And if you have any questions, we've got like 5 or 6 people here, and we have a rule: nothing's off limits. Also, tomorrow, just as a heads up, because usually I only do one speaking time and then I'm out of here, but this time, tomorrow, I'm speaking for the CME at 1:30 tomorrow afternoon, and I'm doing a short futures discussion on, it's about 6 or 7, actually it's about 7 takeaways in 35 or 40 minutes just on futures trading, so if you're interested in that. Again, I'm product agnostic, but they're sponsoring that event, so I'm doing it on futures trading, so if you've never been to one of our futures events, I think you'll like it. It's all strategy, that's it. And everything we do is free, just so you know. So everything that Tasty Trade does, everything I do, we have been doing this for 20 years. We've never charged for a single event, for anything. So enjoy. So my discussion tonight, perfect, starts off with just talking about wealth and what concerns me. There is an unequal distribution of wealth in this country, and actually it's global. It's not just this country. And you've probably read about this, but it's interesting because here the top 1% own over half the country's wealth, but when you talk about it globally, it's happening everywhere. Anytime you get this huge concentration of wealth and huge concentration of decision-making and huge concentration of risk-taking in the same passive environment, it gets a little bit scary. Not since 1962 have we seen anything like this, and the only reason I say 1962 is because we're really not sure before that. So we don't go back much before 1962. But it seems like we've reached almost a pinnacle with respect to a concentration of wealth. And again, it's not just wealth. When you get a concentration of wealth, you get a concentration of decision-making, you get a concentration of risk-taking. And by the way, for anybody that wants this presentation, when you're done, I am more than happy to share it with you and give you the entire presentation. All you have to do is send me an email at tom@tastytrade.com, and we will send you the presentation as we're doing it today. So you don't even have to take a picture or take notes or whatever. Just tom@tastytrade.com, and we'll send you the entire PowerPoint, and you can look at it as many times as you want. In the US, the wealthiest 1% have captured 95% of the post-financial crisis growth. That's since 2008. And for those of you that were trading in 2008, you have now seen the after effects of an incredible meltdown. You see how long it takes for markets to distribute and to kind of normalize. And it's really fascinating because throughout time, I mean, a lot of us were around in the 1987 crash. I was still on the trading floor in 1987. And we've experienced these kind of historic events. And it does take a long time to kind of work yourself out, to distribute after that. But that's interesting that most of the post-crash wealth has been acquired by just a few people. BlackRock, Vanguard, State Street, and 7 other firms each manage over $1 trillion in assets. Now, if you remember long-term capital management, which was when Genius failed, long-term capital management was a meltdown on $2.5 billion. We basically, in 1998, almost took the market down because, again, there was a famous book, When Genius Fails, but because, there was just, there was a kind of a errors in judgment with respect to, what can happen to a position that's short volatility. Size kills, basically. And that was on $2.8 billion. Now, BlackRock, Vanguard, State Street, and 7 other firms have over $1 trillion under management. BlackRock alone has $6 trillion, over $6 trillion now, in managed assets. Now, just when you see this, all the physical cash in the world is just over $7 trillion. So BlackRock's managing $6 trillion, all the physical cash in the world is $7 trillion. Now, when I talk about a concentration of wealth, that's a concentration of wealth. You've got a handful of decision makers managing the equivalent amount of cash as all the cash in the world. So what happens then? Because ultimately, everything gets disrupted. There's nothing in the world that doesn't get disrupted. Nobody stays in a certain position or a certain spot forever. So none of the market leaders from 1987, and like I said, a few of us were trading in 1987, we're still at the top in 2001. When you think about market leaders in 1987, you think about kind of the old blue chips like IBM on down. And when you think about the market leaders in 2001, you're thinking Cisco and Intel and that whole group of chip makers and Lucent and all those other firms. When you think about the market leaders in 2018, the only stock that's even in the team picture is still Microsoft. But when you think about that, that's just normal cyclical disruption. And disruption happens in 2018 way faster than it happens in 2001 and 1987 because technology is much more commoditized and it's much cheaper. So the statistical chance of disruption now in virtually any marketplace is so much greater. I mean, it could be what's happening in the next garage, it could be what's happening in the next dorm room, it could be what's happening in the next company, but there are fascinating stories out there. So it's reasonable to assume, based on everything we know, that today's narrow group of market leaders, which until the last couple of days was really just 5 or 6 stocks, where most of the capital flowed into, where most of the liquidity is, the amount of concentration focused on just a few stocks with respect to liquidity and the top of the funnel. We're talking about a world of passive investors that don't make their own decisions, and there's only so many other places that can handle all that passive investment. So it's reasonable to assume that in 2030, none of those stocks, or very few of those stocks, will still be at the top of the funnel. So why are trillions of dollars flowing into those stocks? How's that possible? Why are trillions of dollars? If everybody thinks like that, or if more people thought like that, if more people thought independently, if more people were able to stand alone, then I'm not sure everybody would be so short-sighted. I'm not sure we could expect a repeat of 1987 or 2001, but what we're looking at right now is more passive investors in 2018 than we had in 2001, and more than 2001 than 1987. Meaning we've gone the other direction. We've gone away from being strategic, we've gone away from individualism, we've gone away from decision-making on a personal level. And we've gone to this concentration of just massive amounts of passive investment. So common sense is kind of losing out, or the commitment to individualism is losing out. So I have a question for you. Would you rather own Amazon at its current market value, or buy all the outstanding shares of the Spiders, the Qs, IWM, and the Diamonds? Those are the 4 major index ETFs. And you'd still have enough cash left over if you bought them all. If you traded Amazon, bought all the outstanding shares, you'd have enough money left over to buy them all again. That's every ETF that you trade stocks, that you trade options on, that you track, all those ETFs, those top 4. You can buy them twice for the value of Amazon where it's currently trading. How about Google at 1,060, just came down from 1,200 bucks. You can own Google at 1,060 and buy out the company or all the silver ever mined in human history. Gold's worth a little bit more, but all the silver. So you got to pass on gold, but you can own all the silver ever mined. Would you rather own Facebook at 145 or own every professional sports franchise and every television network in the globe? I'm just putting some context. What I love doing is putting context around the value of certain companies when you have this massive concentration of of risk-taking and decision-making, where people assume that it's safe. I mean, some of these stocks have had big sell-offs already. Facebook's already down almost 25%. You know, I mean, Amazon's only down about 10% off its highs, or 15%. But some of these stocks have had pretty big sell-offs already. Would you rather own Baba at $144 after their huge Singles Day on over the weekend, or would you rather own every share of every Chinese ETF 50 times over? That's the massive amount of some of these stocks. And when you think about that, you're like, how's that even possible? Would you rather own Netflix at 300? Well, it's actually lower than 300 today. I was on a plane, so I couldn't change these numbers. But would you rather own Netflix at 302? Or every movie ever made? Real quick story for you. I don't want to go off track too much, but I got to tell you this one story because it's one of my favorites about Netflix. So my last long trade in Netflix was I bought it at $9. I sold it at $9.50, so don't get too excited. My last short trade in Netflix was probably the last 10 years, but I got to tell you why. So years ago, when we built our last company, which was Thinkorswim, the firm that invested in us was a private equity firm from Palo Alto called Technology Crossover Ventures, TCV. And they invested $22 million with us. And we had never really had an investor before. We bootstrapped everything we had ever built in the prior 30 years of building businesses. And so when they gave us $22 million, we didn't know what to do with the money. So we kind of just put it to the side in a checking account at 0% interest, mind you. because we weren't sure, and we'd always read the story about how eBay raised their first $4 million, never cashed the check, and kind of just held it off to the side, and we thought that's kind of a cool story. So we didn't cash this $22 million check. At our first board meeting that summer, when we had all these private equity investors, and we never had board meetings before that, all these private equity investors came in, they sat down in our boardroom, and they said, and the market had been slow. Volatility was down that summer, the market had been slow, and there was about 8 people or 10 people sitting at the table, and they looked at me and Scott, my partner, and one other person, and they said, I have to tell you guys, you're the worst company we've ever invested in. And we're like, you've only invested us 3 months ago. We're the worst already? And they go, you're the worst company. We overpaid by a ridiculous amount of money. So we said to them, we'll tell you what, because we loved our company. And we realized right away that taking investment meant that we lost a little bit of control, that we didn't really understand when we took the money. We said, here's the deal, we never cashed your check. So we'll give it back to you. And they're like, what? And we're like, yeah, we'll give it back to you. We'll give you back your check. We never cashed it. We cashed it, but we'll give you back. We never spent a dime of it. So we'll give you back your money because we think we can get more money at a higher rate later on. And they said, you're bluffing. We said, you're bluffing, because we're not the worst company. This went back and forth for about 5 minutes. You're bluffing. No, we're bluffing. And we said, no, we'll write you a check right now. Just don't cash it until tomorrow so we make sure we move the money over. You know, you've done that before, right? We do it all the time. So the private equity firm huddles up, and they said, and they talk, you know how kids talk loud, so when they think you can't hear them, but you can actually hear everything they say? They were doing this on purpose. And they said, do you think these guys are really worse than Netflix? Now, we heard the whole conversation, and we're like, what do you mean? And they're like, well, Netflix was our first investment, and we put like $50 million, let's say, I don't remember the exact number, into Netflix, and we think they're worse than you guys, because we don't think we're ever gonna make a dime in Netflix. So after they said that, they ruined Netflix for me, okay? They ruined it because, number one, I have never bought a subscription to Netflix, and number two, other than buying the stock one time at $9, I've been short it for the last 300 points, pre-split. So they totally killed me, but that was just kind of a funny story that I just remember them saying. They ended up selling out their Netflix for about a $3.5 billion profit, so it was a really good trade for them. On the other hand, I never made a penny in there, and I think I'm the only person in this room, but you can correct me if I'm wrong. I do not have Amazon Prime, and I do not have Netflix, and it's purely a result of my hatred for those companies by being short them both. Does anybody else here not have Amazon Prime? And, oh, there's a couple, and Netflix. That is a parlay bet that should win here. So would you rather own Apple? They actually hit Apple pretty hard today. It closed about a little under 195, but it was 203 on Friday. Would you rather own Apple at 203 or the GDP of Russia? You know, we freak out about Russia, but nobody freaks out about Apple. I mean, Apple has more cash than Russia. I mean, Russia can print their own cash, but Apple at $1 trillion is almost greater than the GDP of Russia. The GDP of Russia is probably hovering around 1.2 trillion, so it's pretty close. Fidelity, BlackRock, and Vanguard control $11 trillion of passive investments. That happens to be very close to the GDP of China. We worry about finance, and we listen to everything from tariff talks to discussions about trade to everything that when it really boils down to China this, China that, Russia this, Russia that. But we don't think that 3 companies with 10 money managers are managing the equivalent of the GDP of China without the oversight in 6 stocks. And when you start to think about that, you got to be like, okay, well, it's worked so far. Yeah, it has worked so far. We had a meltdown in 2008. It's worked so far. But can it continue? So I get in, I don't, it's interesting. We run a financial network, but we actually don't have cable. We have cable in one of our offices, but in the office that I'm in, I refuse to have cable because I refuse to, if you drink Coke, you don't have Pepsi in the refrigerator. I feel that way strongly about about business. So we don't have cable in our office, so I don't watch that many other shows. But we hear experts all the time, from Buffett on down, and they are experts, but we hear the concept of a level head. A level head drives me crazy because that's too easy. That's an easy out. Life's not about, okay, always maintaining a level head. Level head just makes the assumption you don't know anything. That's the heart of the conflict in the world of finances, that everybody's told from day one, you don't know anything. We have an entire generation, we have a whole generation of millennials right now that are being told since they were about 14 or 15 years old with respect to financial literacy, which my definition is completely different than anybody else's, but they're being told that effectively financial literacy is manage your credit cards, learn how to balance a checkbook maybe, or just learn about money, but don't ever think about managing your own money. So we're an entire generation behind, because you know what happens? The next thing you know, you wake up one day and you're 50. And then you're wondering, where the fuck did my life go? And how come I didn't learn anything? You just wake up and you're like, I don't know what just happened. I wish I had learned when I was 22 how to take risk. I wish I had learned when I was like, whatever, what a stock was, what an option was, how a future works. The only thing that kids today do, or I shouldn't even say kids, millennials or any younger generation, it's all 100% asset speculation. Everything is about asset speculation. You know why Bitcoin and digital currencies were so popular? Because how do you turn $100 into $1,000? Asset speculation. Now that digital currencies have an implied volatility of about 20, nobody trades them anymore. That's not finance, and that's not learning about something. What we do is we focus on strategies. We focus on, how do you do things? How do you make decisions? Sometimes your decision-making ability defines the rest of your life. My son came home, he's 26 now, and he came home one day to me and he said, Dad, he was looking for another job, and he said, I got an amazing offer from a company that I wanted to work for. I said, that's great, so you took it, right? He goes, no, I told him I needed the weekend to think about it. I'm like, well, are you my kid? What'd I tell you? Make a damn decision. Like, you don't need the weekend to think about it. You want the job, right? He goes, yeah. I go, you like the job, right? Yeah. He goes, they make a good offer? He goes, yeah. I go, why don't you take the job? Because he goes, well, everybody else told me I should take a weekend to think about it. I'm like, just think how stupid that is. He's like, yeah, what do you know? Robo-advisors drive me insane as well. Robo-advisors drive me crazy. You know why? Because it's just a perpetuation of this passive mentality. There's no decision making. You want column A, column B, column C, and then in case something goes bad, just close your eyes, wake up in 25 years. We call that getting vanguarded to death. Drives me crazy. I can't listen to the concept, to the Jack Bogle mentality, which is just close your eyes and in 25 years, you'll have more money than you know what to do with. It doesn't work that way. Life doesn't work that way. You can't be successful with that approach. The most successful entrepreneurs in the world, the most successful business people, the people that we hire for every job, the first thing we want to figure out from them is, can you make a decision? Can you define a problem? Can you answer a difficult question? And can you make a decision? Can you take risk? How do you know if you're invested properly for your goals if you've never done it before and you're just trusting what somebody else says? How do you know when it's time to invest? It's easy to say buy low and sell high. You ever tried buying low? That's how many people bought today. I was on an airplane, we're in the middle, it looked like the market was crashing to me, and all I was trying to do was sell anything I could. I'm sure I sold 3 bottoms today. And I've been doing this for 37 years, and I sold 3 bottoms today. It's freaking hard to buy low. And then try selling them when they're exploding, like last Wednesday after the midterm elections, and the S&Ps were up 55, and the NASDAQ was up 200. Try selling into that rally. It's not easy. How do you know when it's time to sell? Damn hard. How do you learn about diversification if you've never done anything? Very few people realize diversification is not just product diversification. Diversification does not mean that you buy stocks, emerging markets, and then you buy a little technology, a little emerging markets, and a little commodity stocks. That's not diversification. Diversification, when we go up, everything kind of moves in their own way. When we go down, everything converges to one. And that one means there's no such thing as product diversification. I mean, there are, I shouldn't say no such thing. There's certain commodities, obviously, that have no correlation to certain stocks. But in general, stocks have a correlation of 1 to the downside, and they have some diversification to the upside. So what is diversification then? It's different products, it's different durations, and it's different strategies. And how do you know what to do there? Because you've been watching this market from a distance, you've been watching finance from a distance, but now you're 60. And nobody's ever done anything because you've always been told, hey, let the pros do it. But you are the pros. That's why we're here. That's why there should be 10,000 people here. How do you learn about strategy if you've never done it? It's freaking hard. How do you learn about different products in different markets? How do you learn the difference between a stock and an option and a future? You know what? I beg my kids, and I've only got 2, to trade every day. I don't care if they make or lose money. I want them to make decisions that have an emotional and a monetary outcome every single day of their life, because when they're 35, they're going to have an opportunity to do something extraordinary. If you don't make decisions and you don't take risk, it's hard to do something extraordinary. There's a couple of amazing entrepreneurs. I'm from Chicago, and in the Midwest, we kind of have our own entrepreneurial community. And our firm's right in the middle of this whole tech scene and everything else. We've been there for like 20 years. And some of the most amazing tech entrepreneurs and venture entrepreneurs that I've ever met, the one thing I could take away from each person, if I was to throw them all in a room, they can make a decision at the blink of their eye. They just blink their eyes, they make a decision. It could be a $5 million decision, it could be a $500 million decision, it could be a $5 decision. They make a decision instantly, and I love that. And every successful entrepreneur or business person you run into makes immediate decisions. How do you improve your chances of success? There's no such thing as, I don't like one-hit wonders. I don't like, luck means nothing to me. What happens if the market doesn't bounce back? What do you do with new monies? If you've never done any of this stuff before, what do you do? What if you realize that you know more than your advisor? What if you realize that you know more than the talking heads on cable, more than the expert newsletter writer? A couple of years ago, and I don't want to go over here, so let me just watch. A couple of years ago, I hired somebody from CNBC, actually the person that started Fast Money, Dylan Ratigan. And I love Dylan. He's a really close friend of mine. He left this year to go run for Congress, which he didn't. He lost in the primaries. But I really do like him. He's one of the most brilliant people I've ever met. And I could sit in a room and talk to him for, 20 straight hours. Fascinating character. He started Fast Money. He was the youngest editor on the Bloomberg news desk. And like I said, he has a photographic mind. He can remember everything. When he started working for us, the reason he came to work with us is because I challenged him. I challenged him and said, for a brilliant guy, you don't know jack about trading in markets. And he goes, how do you figure? I've been talking about it on the air for 10 years straight to the whole, I have 1 million YouTubers, I have 1 million people on Facebook, I've got this and that. Have you ever made a trade? No. I go, so you're the expert. You've never made a trade. You're invested in a couple of index funds. I said, you stink. You're an embarrassment to what we're trying to accomplish here. And he took that as a challenge. And he said, you're wrong, and I'm going to prove you wrong. And I go, beautiful. That's what I was trying to do the whole time. And it was very interesting working with him to get him excited about markets, because his entire opinion of everything changed almost overnight. As soon as he saw, hey, this is pretty hard. This is pretty difficult. Efficient markets, man, there's no edge. It's just you don't want to give up any edge. Like it's all, you want it to be completely fair. And he saw that almost instantly, and everything he had ever done before that changed. And so I say this, but I say it also in a really friendly, respectful way, because there's a lot of brilliant people out there talking about finance, but until you've actually done it, which drives me crazy about some banks and large financial institutions, they don't let you trade. Like, we encourage every one of our employees, go out there and trade. We love it. Trade all you want. We want you to be knowledgeable about our products. But then we have people that call us up all the time and say, hey, we watch your show. I'd love to trade, but I'm not allowed to. I never understood that. What do you do if your portfolio doesn't grow? And you're sitting there and the markets go sideways, markets go down. We haven't seen a bear market. We haven't seen a decline. We haven't seen a market that's gone lower for any significant period of time since 2008, 2009. So, you forget. You forget quickly. What about learning to take risk? What about learning to make financial decisions? What inspires you? What engages you? Where does the passion come from? You know what? Just making money because you flipped a coin and you were right means absolutely nothing to me. It has to be scalable and it has to be repeatable, and that's so freaking hard to do. So catchy one-liners, they sound good, but they're meaningless, and what's worse, so are the firms that promote those. So bull markets, it's one of my favorite lines, bull markets make dumb people look smart, and they make rational people look crazy. When you think about that for a second, you're like, eh. So if markets are truly random, which we believe they are, then it's all just a math equation that will eventually normalize itself. Now, let me explain. Price is not mean reverting, which means if a stock goes from $10 to $100, it doesn't mean it's going back to $50. It's not mean reverting. But volatility or expected move is a math equation, so fear is mean reverting. And there's a big difference between the two. And if you learn how to incorporate fear, and fear is another word for opportunity. And if you learn to incorporate fear and opportunity into kind of a big thought process, then all of a sudden, it's a math equation. So the crazy people somehow become geniuses, and the smart people go back to being clueless. That's called being a hedge fund manager. A very successful one at that. So mean reversion, as it applies to expected move, is a wonderful thing. Expected move, when you hear the term implied volatility, which everybody freaks out about, all that means, volatility is just another word for expected move. Implied volatility is another word for expected move. Historical volatility is realized volatility, which is what's happened in the past. Implied volatility is what's expected to happen in the future. So when you hear things like, what's a reasonable expectation for the market, it's always based on implied volatility because it's a two-sided market, and if it's tradable, it's real. So here are my suggestions for succeeding in today's opportunistic marketplace. Don't be afraid of heightened expected move because it's a gift, not a curse. Opportunity is a gift. Strategic diversification is as significant and as important as product diversification. Stay small. We used to say trade big or go home, the whole deal. If you weren't a big trader, you didn't even deserve to be around. Now, entire mentality, all our research has shown us, we're a think tank, basically. Tasty Trade is a think tank. We have 8 to 10 full-time researchers all the time, all data scientists, and all we do is try to bust every myth that's ever been created about trading and investing. So stay small, aggressively manage your winners, aggressively manage your directional risk, and there's not much you can do about losers, so don't worry about those. We've always been told to manage your losers and let your winners run. It's exactly the opposite. Manage your winners and deal with your losers as you may, because there isn't anything you can do. Keep your decay numbers, which is the amount of premium that you've sold out there when you get to that point. And remember, most important, liquidity rules. For individual investors, if you're going to invest, stay liquid. There's no reason, there's about 150 what we call 4-star liquidity underlyings. You don't have to go outside of that. You go to 3 stars, that's fine, but 2 and 1 stars, which means there's not a lot of volume or there's fees, whatever it is, focus on liquidity. Liquidity means that nobody can take advantage of you. Manage your capital efficiency and be product indifferent. It should make no difference to you what the underlying really is if you're being strategic. Sometimes you want to buy gold, so you invest in gold. But other times, you're just looking for opportunity based on fear. Don't hesitate to adjust. There's no such thing as overtrading anymore because the fee structures have come down so dramatically that it's a notch over free. It's cheaper for individuals to trade and invest now than it is for the exchange members that are actually making the markets. Take advantage of implied volatility rank, which is implied volatility measured against itself when it gets over 75, and we're there right now in many cases. Lean more towards ETFs and indexes when implied volatility gets over the mean. The mean's 15, so when it gets up to 17.5, there's some edge in there. Because remember, volatility is mean reverting, which means 65% or 70% of the time it contracts. 30% of the time it expands. And taking advantage of that is something you need to learn how to do as a strategist. Keep your available capital to at least 40%, and you're always around to play. Most people overinvest. When we built our first brokerage firm, the average size trade was a $50 stock, because the market was lower at the time, was 700 to 1,000 shares. So say the average size trade was about $45,000 in notional value. The average customer account is $40,000. So the average customer was trading their entire notional size of their accounts with every trade they made. It's insane. Today, with our new firm, it's all retail too. We have no institutional customers, no professionals, nothing, just customers. The average customer trade is a few $1,000s, like $2,000 or $3,000, and the average customer went from trading 170 times a year. Here, let me rephrase this. When we built our last firm, the industry average was 22 trades a year. When we built our last firm, we got it up to 170. With our new firm, we have it up to 1,200 trades a year per customer. The reason is people are trading a fraction of the size because we've commoditized rates. So you can trade really small, you can trade often and make adjustments, and it costs you no more than it cost you to make 20 trades, 20 years ago. Staying active in volatile markets is a confidence builder. Nothing feels better than when the wind's howling and you're on the golf course and you've got 170-yard shot into a gale force wind and you stick it. And you're like, I can't believe I just did that. Because you figured you were reaching into your bag to get another ball. It's the same thing when you trade in volatile markets like today. If you traded today and you had some success or you felt good about it, you're going to forever be better. If financial opportunity was obvious and obvious worked, everyone in the room, everyone in Las Vegas would be filthy rich. Fortunately, though, obvious does not work. And for those who stand to the side, to stand alone when the herd comes racing by, they will ultimately benefit the most. I know that sounds like it's so cliche-ish, but it's so hard to do. Here's what we know. This is just masters of the obvious right now. Tax cuts lead to buybacks, which leads to an earnings boost, which you've seen. Global growth looks great. This is what you're told. Inflation remains at bay. The dollar is ridiculously strong. Amazon is taking over the world. So, give up on these noticeable red flags. Greatest concentration of wealth and decision-making in history. Markets that don't correct until recently. We had 2 corrections this year, one recent and one in February. But over the last 10 years, corrections have been few and far between. We have a flat yield curve. That means the difference between long-term and short-term rates is at historic lows. And bonds, by the way, have sold off dramatically. Anybody that's been long bonds for the last 3 years, you understand the term convexity now. That's bond risk. That's principal risk in bond market. There's nobody up money in bonds the last 3 years. Nobody. So that's another reason to be nervous about stocks. Volatility is consistently 20 to 30% below historical norms until the last couple of weeks. There is a record percentage of people that have no idea what they're doing. That should scare everybody. For me, that makes me feel amazingly good because and it should make everybody here feel good, because anybody that's spending their Monday night in the room listening to me at 4 to 5 o'clock is in a completely different stadium than the rest of the world. There's record margin debt, but we've seen that before. This is something that I love, and you've heard me say this before. Robert Schuller, who is the head of finance at Yale University, and runs their graduate program, of which we have many a professor that are tasty traders, believe it or not, from Yale in the finance group. We don't know the probabilities of future events. Still, you have to take action, and so you do it on gut feeling. Now, Schuller won a Nobel Prize for saying something, and I quoted him on this, because it is idiotic. We do know you can actually make a bet on the future event of virtually anything in a listed marketplace which is centrally cleared and fungible. You want to bet that the Dow is going to be 300 points higher or 300 points lower or 3,000 points higher or 3,000 points lower 18 months from now? Go right ahead. The market's 3 cents wide. You want to bet that gold is going to trade 1,500 or 700 2 years from now? The market is a nickel wide. You want to bet that soybeans are going to be up, trade 15 or 5 2 years from now? The market is 1 tick wide. How about S&Ps? Are they going to close at 3,000 or 2,000 15 months from now? The market is 1 tick wide. So that market, since it's tradable, gives you an exact number. It's fascinating what's out there now. So there is no such thing as gut feeling. Gut feeling, it doesn't make any sense. So never underestimate the power of stupid people in large groups. That was our friend George Carlin, who is no longer here, but you know, I love talking to this group because you actually remember who George Carlin is. I did an event somewhere, I was talking to a bunch of high school kids and everybody's like, Googling George Carlin. That really threw me for a loop, by the way. So let's stop rewarding luck and start embracing know-how, because that's what we should be doing. We shouldn't be looking at investment gurus and people out there because they made $5 billion or because, you know, they were managing somebody else's money or whatever it was, or they're saying something on TV. There needs to be a certain amount of rewards for passion and engagement that gets people to do certain things. This is why brains work and why bots are iffy. Everybody talks about artificial intelligence taking over the world, but the reality of artificial intelligence is you need one thing to happen for artificial intelligence to work, and that's inefficiency. And if you can make a market 2 years out right now in the S&Ps and make it 1 tick wide, there's no inefficiency there. So there's no such thing as artificial intelligence being able to help 2 years out and where the S&Ps are going to be. Artificial intelligence needs a failure of efficiency to work. So you're not up against some market that is delivering this, that has this huge advantage. Everybody worries about high-frequency traders and high-frequency this and that. I read it all the time. I read an article this weekend in the Wall Street Journal from last week about high-frequency traders and how this one brokerage firm was selling their order flow, and I'm thinking to myself, oh my God, nobody's ever done any research. You can do, we're not a high-frequency firm, by the way, we're just a retail firm. Everything you can do today, you can do it because there is an amazing amount of technology being delivered by high-frequency traders that improves your technology, that lowers your fee structure, and that makes tight markets that none of the exchanges have ever been able to accomplish. The whole world of high frequency is what allows us to do everything that we want to do. They're 1 tick wide on 1,500 markets. What do you want to do? It's the most beautiful thing out there, but nobody gets it. That's why editors at just all these different financial publications drive me insane. And when I have these discussions with them, they kind of, that's interesting, Tom. Now let me go get a quote from Goldman Sachs. Decision-making skills are learned through doing. There is no other way to do it. Being a contrarian allows you to remain consistent. Being passive is destructive to wealth creation. And wealth doesn't always just mean money. Wealth can mean lots of other things. Wealth can mean, hey, you know what? You're 32 years old, and all of a sudden, you make a lot of decisions, and you've heard me say this before, I've talked about this at many an event. There's such a thing called economic bias. Economic bias is the inability to decide what something's worth. Here's an iPhone. For somebody that's never seen an iPhone before, there's 2 types of people out there. Those that make thousands of decisions, that can look at this iPhone for whatever reason, assess it in a couple of seconds, and make some kind of market. Okay, my market of this iPhone, it's used 600, 700, something like that. Somebody that's never seen this before, number one, they won't even make a market. If they do, they'll say, I'll pay 100, I'll sell it for 10,000. That's called economic bias. It's the inability to make markets. It's the inability to assess value. The reason that exists is because people don't make decisions. Those who make decisions are much more valuable. When we hire somebody, all we care about, obviously we care about how smart they are, but we also care about their ability to make decisions. It's a critical part of the thinking process. You can't create lifetime wealth without the ability to make decisions. Extreme asset speculation happens when too few people make too much money, they make too many decisions, and they have too little experience. Welcome to 2018. Sometimes logic, common sense, and gravity don't work, but that's okay because most of the time they do. 85% of the time, just remember this, just in the back of your head, 85% of the time, most stuff, 68% of the time, everything falls within some distribution curve. But 85% of the time is kind of your ballpark number. 85% of the time, you can make a reasonable adjustment. 15% of the time, things fall outside that range. That's why we say logic, common sense, and gravity, you know what? Sometimes they don't work, but most of the time, they do. That is my discussion today.